Right now, over 80% of retail traders staring at the 1-hour chart of cable are convinced this is the bottom. They're buying every green candle, celebrating a 0.5% bounce, whispering about a trend reversal. But here's the cold truth. This is exactly the same lower timeframe trap that wrecked longs 2 weeks ago right before a 300 pip collapse. There is one danger zone and one hidden opportunity sitting right on your screen, and I'll show you both within the next 90 seconds. Stay locked to the end. I'm giving you 3 exact levels you can trade today, complete with entries, stops, targets, and the single invalidation line that will flip this whole structure. This is not a forecast. This is an institutional roadmap built from order flow, moving averages, MACD divergence, and the positioning data that the herd never sees. Let's get the instant market verdict. Cable is currently trading at 1.3198, up exactly 0.24%, a dead cat bounce gasping for air inside a brutal bear trend. The monthly trend, sell. Weekly trend, strong sell. Daily trend, strong sell. The 5-hour is neutral, and only the 1-hour is flashing strong buy. That multi-timeframe conflict right there is the classic signature of a trap. When higher timeframes are screaming in one direction and the 60-minute paints a pretty reversal, the lower timeframe move is almost always a liquidity grab designed to suck in breakout buyers before the real selling resumes. My session bias is unequivocally to fade this rally. A range bound within a descending structure, with 1.3205 as the ceiling and 1.3100 as the magnetic support floor, but the pressure is building for a breakdown, not a breakout. Write this number down. If we get a daily close above 1.3250, the entire bearish structure resets, and we could see a violent short squeeze toward 1.3400. But as long as we remain below that line, every single pop is a sell opportunity, and the probability of freefall toward 1.3061 and eventually 1.2700 increases dramatically. Now, here's where the herd is positioned. Retail sentiment surveys show 62% net long, emboldened by an RSI reading of 37 that feels oversold and stochastics dipping to 22. They're buying the dip, thinking mean reversion. But the ADX is at 28. That's a number that screams trending market, not a bouncing market. In a strong bear trend, RSI can coil in the 30s for weeks while price continues to plummet. The smart money is using this exact pause to reload shorts at better prices. The pivot point at 1.3172 is today's intraday control. Above it, the bounce can breathe for a few hours. Below it, the sellers regain full command instantly. Let's walk the charts, top to bottom, because understanding the full gravity of this setup requires seeing what most retail traders never look at. On the weekly time frame, pound sterling to US dollar printed a massive bearish engulfing candle 3 weeks ago that swallowed the entire 1.3400 handle. The 20-week moving average is now sloping aggressively lower at 1.3310, and price hasn't even dreamed of touching it. The 200-week moving average sits all the way down at 1.2600, and that level is alarmingly close to the institutional ATR target of 1.270 that a major desk published just hours ago. That's not a random number. That's the magnetic pull of the long-term trend. When you see weekly moving averages fanning out with price below all of them, that's a textbook bear market in motion. Now drop to the daily. Here's where it gets surgical. The daily chart shows a perfectly structured series of lower highs and lower lows since the 1.3850 peak in early June. A descending trend line from that peak connects with today's high around 1.3215, making this bounce a precise tag of dynamic resistance. The daily moving averages are stacked in bearish alignment, MA20 at 1.3310, MA50 at 1.3380, MA200 at 1.3373, all trending down, with the 20 well below the 50 and 200, a death cross that has been accelerating. The MACD is negative at minus 0.007 with the signal line above it, no bullish crossover in sight. RSI at 37.56 has plenty of room to fall before hitting true oversold territory. The stochastic reading at 22 might make inexperienced traders itchy to buy, but here's what most traders miss. In a persistent downtrend, stochastics can stay embedded below 20 for extended periods, generating nothing but false buy signals. The oscillator doesn't dictate the trend dictates the oscillator's behavior. The 4-hour chart reveals the kill shot for this bounce. We are seeing a classic bear flag pattern, with price coiling under resistance. But look closely at the 4-hour MACD. While price has made a slightly higher high on this bounce, the MACD histogram has made a lower high. That's a textbook hidden negative divergence. Buyers are exhausted. The impulse behind this rally is decaying even as price ticks up. The 4-hour moving averages, MA20 at 1.3310, MA60 at 1.3350, MA200 at 1.3380, are way above, acting as a concrete ceiling. On the 60-minute chart, we see the strong buy signal, with the MA20 crossing above the MA60, but this is mere noise within the larger bearish framework. Think of it this way. The 60-minute is like the second hand of a clock, the daily is the hour hand. You don't bet on the second hand's direction when the hour hand is falling. The critical support levels below are S1 at 1.3133, which aligns with the overnight demand zone, S2 at the psychological 1.3100 round number and last week's swing low, and S3 at 1.3061, a structural fulcrum. Resistance is led with a 1 at 1.3205, R2 at 1.3244, and a 3 at 1.3277. The pivot at 1.3172 is the intraday axis. If we get a 1-hour close below that pivot, the trapdoor swings open. And here's your retention bridge at the 3-minute mark. The hidden divergence on the 4-hour is the exact same signature that preceded the last two 200 pip drops. Most retail traders will see the 1-hour green candles and go long right into the smart money sell orders. Don't be that trader. Now let's connect this chart picture to the fundamental firestorm and crosser set linkages that are really driving the pound. Sterling today is taking what news headlines call a breather as risk sentiment steadies. But that's a sugar-coated way of saying that a temporary stabilization in equity futures is giving pound longs a false sense of security. The true engine behind pound sterling to US dollar right now is the widening chasm between Bank of England and Federal Reserve policy expectations. The bow minutes have leaned increasingly dovish, hinting that another rate cut is on the table, while Fed Chair Powell made it painfully clear that a July cut is off the menu. This policy divergence has slammed the UK-US 2-year yield spread to levels not seen in months. When that spread widens in favor of the dollar, cable suffers, tick for tick, almost mechanically. Look at the analyst note that dropped today. Pound sterling to US dollar on the move. We are looking to the ATR target 1.270. That is a 500 pip bearish call from current price, rooted in the expectation that the yield differential will continue to crush sterling. The dollar index, DXY, is coiling for a breakout above 106, and when DXY flexes, cable gets destroyed. Crosser set confirmation is also screaming from euro to pound sterling, which has been surging higher. Pound weakness is not just a dollar strength story, it's a domestic UK story. Inflation in the UK is stickier than expected, yet growth is faltering, creating a stagflationary backdrop that terrifies global capital. The 1-2-week directional lean is decisively bearish, targeting 1.3060 first, then an acceleration toward that 1.270 analyst objective. The exact event that invalidates this? A weekly close above 1.3450 is the structural line, but that's far away. In the immediate term, a daily close above 1.3250 puts the bear flag on hold and could ignite a short covering rally to 1.3400. I'll ask you now, do you think the dollar index breaks 106 this week? Comment yes or no. I'm tracking consensus across my entire subscriber base, and I'll reveal the results in tomorrow's analysis. This helps us all see where the crowd is leaning and whether we are fading sentiment correctly. Most people skip this next section. They hear the analysis, they nod, and they close the video without a concrete trade plan. That's exactly where the money is made, in the execution. So keep watching, grab a pen, because I'm giving you 3 structured setups, from conservative to aggressive, all built around the levels we just dissected. Every strategy comes with exact triggers, precise stop-loss logic, 2 profit targets, and clear invalidation criteria. No ambiguity. Strategy 1, the sniper. This is the conservative, wait for confirmation play that aligns your entry with the moment the trap snaps. We wait for the 1-hour candle to close below the pivot point at 1.3172. That closure confirms that the intraday buying pressure has evaporated and the bears are reclaiming control. Entry is a sell stop at 1.3168, place just below that pivot break to catch the momentum. The stop loss goes at 1.3225, above today's high and a 1, giving you 57 pips of cushion, slightly less than the 14-period ATR of 84 pips, so it respects volatility while staying tight. Take profit 1 is at 1.3133, the exact S1 support, netting 35 pips. Book partials there. Take profit 2 is at 1.3100, the psychological S2, for a total of 68 pips. The risk to reward on TP2 is roughly 1 to 1.2. Modest but with a high probability because you're entering only after confirmation and with the dominant daily trend. Invalidation. If any 4-hour candle closes back above 1.3205, the setup is void. Cut the trade immediately, now, on-screen graphic for the editor. Overlay this as a clean trade card while I speak. The sniper, conservative, entry. 1.3168, sell stop, 1H close below 1.3172, stop loss. 1.3225 take profit 1. 1.3133 take profit 2. 1.3100 risk, reward. 1:1.2R invalidation. Void if 4H close above 1.3205. Strategy 2, the active trader. This is for those who want to get in front of the crowd, selling into the bounce before it rolls over. You use a sell limit order at 1.3205, right at R1 resistance and the top of the 4-hour bear flag. You can place that limit now and let the market come to you. The stop loss sits at 1.3260, above R2 and last week's swing high, a 55 pip risk. That's a clean technical invalidation. If price breaks above there, the bear flag is busted and the structure has changed. Take profit 1 is 1.3133, S1, for a 72 pip gain. Take profit 2 is 1.3100, the S2 level, for a 105 pip gain. That delivers a risk reward of 1 to 1.3 on the first target and 1 to 1.9 on the second. Very respectable. Trailing stop rule. Once TP1 is hit, move the stop to break even on the remaining position, then trail by 30 pips. This setup leans heavily on the concept that the 1-hour strong buy is simply a liquidity grab, and smart money will fade it at a price level they've already marked. It's my preferred setup for the patient trader. The active trader, standard, entry, 1.3205, sell limit, stop loss, 1.3260 take profit 1, 1.3133 take profit 2, 1.3100 risk, reward, 1:1.9R, to TP2, invalidation. Void if daily close above 1.3260. Here's the interaction cliff. Type your pound sterling to US dollar range for tomorrow in the comments right now. Give me a high and a low. Let's see who's aligned with the 1.3100 magnet. I'll read through these and highlight the most accurate calls in the next video. Strategy 3, the aggressor. This is high risk, high reward, designed for traders who can lose small and manage risk aggressively. We're going to attempt a momentum short on a sudden breakdown below intraday support, chasing the collapse in real time. Entry is a sell stop at 1.3150, placed below the current 1-hour low and just under the pivot, triggered only if price slices through with momentum. Stop loss is tight at 1.3185, only 35 pips, just above the pivot point. The logic: if the breakdown fails and price reclaims the pivot, the trade thesis is instantly wrong, and you're out. Take profit 1 is 1.3100, a quick 50 pip scalp. Take profit 2 is 1.3061, the S3 level, 489 pips. That gives you a risk reward of roughly 1 to 2.5 on the second target, but the probability is lower due to the tight stop and noise. Invalidation. A 15-minute candle close back above 1.3180 voids the setup immediately. Only take this if you're comfortable with a fast loss and have already banked profits elsewhere. The Aggressor, high risk, entry. 1.3150, sell stop loss. 1.3185 take profit 1. 1.3100 take profit 2. 1.3061 risk, reward. 1:2.5R, to TP2, invalidation. Void if 15-minute close above 1.3180 risk management pulse, 30 seconds. Never risk more than 1 to 2% of your account on any single trade. These setups are precise, but the market can and will do something unexpected. No positions through high-impact news. Set alerts for UK CPI, US NFP, and any unscheduled BO or Fed speech. Stops are non-negotiable. They are your seatbelt. The goal is survival. Survive the bad trades, and you'll be there to catch the next 200 pip collapse. Here's the close and retention loop. The single most critical level for the next session is 1.3172, the pivot. If London opens and we are trading below it, the bearish momentum will accelerate fast, and 1.3100 will be in sight within hours. If we hold above it, expect one more futile poke toward 1.3205 before the rug pull. Tomorrow, I'm watching the US durable goods data at 8:30 a.m. Eastern. That's the potential catalyst for the DXY breakout that crushes sterling. If you want the full institutional breakdown on Bitcoin and the S&P 500 divergence, that video is live right now. Tap the end screen card. Smash the like button if this gave you a clear, tradable plan. Subscribe, hit the bell, and I'll see you in the next one. Same intensity, same focus, same commitment to turning volatility into profit.